The wealthiest 400 Americans pay an effective tax rate of 24%. The average worker pays 30%. Jeff Bezos paid $0 in federal income tax in 2007 and 2011. This isn't a broken system. This is a system working exactly as it was designed to work, and the design wasn't an accident. The question everyone asks is why? Why do I pay more in taxes than a billionaire? But that's the wrong question. The real question is this: who built a tax system that legally permits billionaires to pay nothing while taking 30% from your paycheck before you even see it? And what did they gain by designing it that way? Because once you see the architecture, you realize this wasn't broken by neglect. It was built with purpose, and that purpose has never been about fairness. Here's what this video is actually about. For over a century, the American tax system has been constructed piece by piece, policy by policy, to shift the burden from wealth to work, from capital to labor, from those who own to those who earn. And the numbers prove it. The ultra-rich paid an effective rate of 30% in 2010. By 2020, that rate had fallen to 23.8%. Meanwhile, top wage earners, people who depend on salaries, not investments, pay 45%. The gap isn't closing, it's widening. And it's not a bug in the system, it's the system. This matters to you personally because every percentage point they don't pay, you pay. When corporations received $188 billion in tax breaks in 2024 alone, that's $188 billion in foregone revenue. Revenue that could have reduced your tax burden, funded infrastructure you use, or lowered your cost of healthcare. Instead, it stayed in corporate accounts while your paycheck got taxed at the full rate. The wealth gap between workers and the ultra-rich has exploded since the late 1970s. The richest 0.01% saw income growth of 103% after taxes between 1979 and 2021. The bottom 20% saw 132%. That didn't happen by chance, it happened by design. In 2022, the top 25 wealthiest Americans saw their collective wealth rise by $401 billion. They paid $13.6 billion in federal income taxes over 5 years. That's a true tax rate of 3.4%. You, earning $70,000 a year, pay roughly 14%. Warren Buffett paid $23.7 million in taxes on $24.3 billion in wealth growth. That's a tax rate of 0.1%. Not 10%, 0.1%, 10 cents per $100 of wealth created. Meanwhile, you're taxed on every single dollar you earn before it even hits your account. So how did we end up in a system this broken without anyone noticing? Because it wasn't built overnight. It was constructed methodically, beginning over a century ago, by people who understood exactly what they were creating. The modern American tax system didn't evolve naturally, it was designed. And the architects weren't politicians responding to popular demand, seligmen. These men drove the intellectual transformation in tax law and policy. They built the groundwork for what they called a new fiscal order. But here's what they actually built: a system that protects industrial capitalism in a more humane, equitable form. Not redistribution, protection of capital. In 1913, the 16th Amendment was ratified, making income tax constitutional. That same year, the federal government adopted a graduated income tax. It was sold to the public as taxing the wealthy elite. And at first, that's what it did. But the design included something crucial: the distinction between earned income and investment income. Wages were taxed immediately and at higher rates. Profits from investments, capital gains, were taxed lower and only when realized. That distinction, baked into the system from day one, is the foundation of everything that followed. The designers promoted taxation based on ability to pay. Sounds fair. But what it actually did was give the state authority to reallocate fiscal burdens and redefine who pays what. And the system was never neutral. It was explicitly designed to reshape state power and manage the massive economic inequalities of the Gilded Age. The architects saw progressive taxation as a safety valve for systemic tension, not genuine redistribution. They built a system that looked like it taxed the rich but structurally limited its redistributive potential from the start. By the 1930s and 1940s, during the Great Depression and World War II, the system began to show its true nature. Top marginal tax rates on wages soared, peaking above 90% for the highest earners. But capital gains, the income of the wealthy, were taxed at half that rate or less. In 1942, taxpayers could exclude 50% of capital gains income if they held assets for 6 months. That meant capital gains were taxed at roughly half the rate of wages. A worker earning $100,000 could pay 90%. An investor earning $100,000 in capital gains paid 45%. Same income, half the tax. The system had officially begun favoring capital over labor. By the 1980s, the disparity was policy. The Tax Reform Act of 1986 set the top capital gains rate at 28%, while labor income had come down from 70% to 28% as well, temporarily narrowing the gap. But subsequent legislation raised wage taxes again while keeping capital gains low. Today, the top federal rate on wages is 37%. Long-term capital gains are taxed at 20%. Add in payroll taxes, and workers face a combined marginal rate near 49.4%. Investors don't pay payroll taxes on capital gains. They pay 20%, period. If this pattern was obvious in hindsight for previous generations, why are we still inside it now, and why is it accelerating? Because the system isn't just old law. It's being actively reinforced. In 2017, the Tax Cuts and Jobs Act slashed the corporate tax rate from 35% to 21% permanently. That cost $1.3 trillion over 10 years in foregone revenue. There was no equivalent tax cut for workers. In fact, many individual provisions in that law expire in 2025, but the corporate cuts don't. Corporations got permanent relief. You got temporary. The same law created a 20% deduction for pass-through business income. Owners of S-Corp, LLCs, and partnerships can now deduct a fifth of their income before calculating taxes, dropping their effective rate from 37% to 29.6%. If you're a salaried worker, you can't claim this deduction. It doesn't matter how hard you work or how many legitimate business expenses you have. The deduction is unavailable to you by design. In 2022, 76% of the dollars from this deduction went to taxpayers earning over $200,000. It's not a middle-class benefit. It's a wealth protection mechanism. Meanwhile, corporate tax revenues have collapsed. In 2022, corporate taxes accounted for just 1.3% of GDP. That's historically low, lower than almost any other wealthy nation. In the 1950s and 1960s, corporate tax revenues were more than double that as a share of the economy. The rate has been cut in half, and the revenue has collapsed proportionally. The gap was filled by taxing workers more. Let's talk about a specific mechanism that makes this possible: unrealized capital gains. This is the largest loophole in the system, and it's completely legal. When you buy stock, real estate, or any asset and it increases in value, that increase is called an unrealized capital gain. It's real wealth. Your net worth goes up, but it's not taxed, not until you sell. And if you never sell, it's never taxed. In 2022, America's billionaires and centimillionaires held at least $8.5 trillion in unrealized capital gains. That's $8.5 trillion in wealth that has never been taxed and might never be taxed under current law. Here's how the wealthy use this. They don't sell their assets. Instead, they borrow against them. Carl Icahn, the billionaire investor, maintained a $1.2 billion loan with Bank of America, secured by real estate and other assets. He paid no federal income tax in 2016 and 2017 despite reporting $544 million in adjusted gross income. How? Because loans aren't income. The IRS doesn't tax borrowed money. So Icahn accessed over $1 billion in liquidity, lived off that money, and paid zero income tax. When he dies, his heirs will inherit those assets with what's called a stepped-up basis, meaning they'll never pay capital gains tax on the appreciation that occurred during his lifetime. The wealth passes tax-free across generations. This isn't unique to Icahn, it's standard practice. Elon Musk paid zero federal income tax in 2018. Jeff Bezos paid zero in 2007 and 2011. Not because they broke the law, because the law allows it. You can't do this. You earn a paycheck. It's taxed immediately. Withholding takes it before you even see the money. The IRS gets paid first. You get what's left. But billionaires structure their lives so they have no taxable income. They hold assets, borrow against them, and live off loans. No income, no tax. So what happens when you realize that the system isn't broken, but designed exactly this way, and that design is being actively defended by people with billions of dollars and armies of lobbyists? The carried interest loophole is another perfect example. Hedge fund and private equity managers earn a share of their fund's profits, typically 20%, called carried interest. This is their compensation for managing the fund. It's income, but it's not taxed as income. It's taxed as a capital gain. So instead of paying the top income tax rate of 37%, they pay the capital gains rate of 20%. That's a 17 percentage point discount on billions of dollars in earnings. A fund manager earning $100 million in carried interest pays $20 million in taxes. If that were taxed as ordinary income, they'd pay $37 million. That's a $17 million tax savings per $100 million earned, just by calling it something else. This loophole has been widely criticized for decades. Both political parties have promised to close it. It's still there. Why? Because the people who benefit from it spend millions on lobbying and campaign contributions to keep it. In 2024, the financial industry spent over $600 million on federal lobbying. That's more than $1 million per member of Congress. When a loophole saves you $17 million per $100 million earned, spending a few million to protect it is a bargain. Meanwhile, you can't even deduct your commute to work. The IRS explicitly states that travel between your home and your regular workplace is a personal expense, not a business expense. No deduction allowed. Doesn't matter if you drive 50 miles each way. Doesn't matter if gas costs $4 a gallon. Personal expense. But if a corporation owns a private jet and flies executives to a business meeting, that's a fully deductible business expense. Same function, transportation for work. One is deductible, the other isn't. The system was designed that way. In 2025, employers can offer up to $325 per month in tax-free commuter benefits for parking or transit. That's $3,900 a year. Sounds helpful until you realize that's a fringe benefit controlled by your employer, not a deduction you can claim. And it's a rounding error compared to the cost of private jet travel, which corporations deduct in full with no cap. Corporations paid zero federal corporate income tax from 2018 to 2022, zero. These aren't small businesses struggling to survive. These are some of the most profitable companies in the country. 109 corporations paid zero federal tax in at least one of those years. How? Through legal deductions, credits, and offshore structures. The tax code allows it. It was written to allow it. These same companies often pay higher tax rates to foreign governments than they do to the United States. Government lost an estimated $135 billion in revenue in 2017. Corporate philanthropy that same year totaled less than $20 billion. So corporations avoided $135 billion in taxes and gave back $20 billion in charity. That's a net extraction of $115 billion from the public, rebranded as corporate responsibility. What does this actually mean for someone with a mortgage, a car payment, and a paycheck that gets taxed at 30% before they see it? It means you're funding the system almost entirely on your own. The top 5% of earners paid $1.3 trillion in income taxes in 2022, which was 61% of the national total. That sounds like the rich are paying their share until you realize that statistic includes high-earning workers, doctors, lawyers, engineers, people whose income comes from wages, not wealth. Those workers are paying 45% effective rates. Meanwhile, the top 400 wealthiest individuals whose income comes from investments paid 24%, and the top 100 wealthiest paid 22%. The more wealth you have, the less you pay. Since 1979, the system has shifted wealth from workers to the ultra-rich at a staggering pace. The top 0.001% experience 1 and 3% cumulative income growth after taxes and transfers. The bottom 20% saw 1 and 32%. The richest 1% now earn on average 139 times more than the bottom 20% after taxes. That gap didn't exist in the 1970s. It was created by tax policy changes over the last 40 years. The system was redesigned to produce this outcome. Billionaires' collective wealth increased by $2.1 trillion. Not over a decade, over 2 years. While millions of workers lost jobs, lost income, lost security, billionaire wealth grew by over $2 trillion. And because that wealth came primarily from unrealized capital gains, almost none of it was taxed. The system allowed them to extract $2.1 trillion in value during a crisis and pay virtually no tax on it. So which stage are we actually in right now? How much further does this go before something breaks? History offers a clue. We're not in the early stages anymore. The system has been in place for over a century. The preferential treatment of capital over labor has been policy since the 1930s. But the acceleration happened in the 1980s and intensified after 2000. The 2017 tax law was the most recent escalation, not the first. Each decade, the burden shifts further onto workers and off of wealth. Each decade, the gap widens. We're deep into the pattern now, and the trajectory is clear. If you taxed billionaires at the same effective rate that workers pay, roughly 30 to 45%, the additional federal revenue would be somewhere between $500 billion and $1 trillion annually. One estimate suggests that increasing the top 1% tax rate by just 10 percentage points would raise $300 billion per year, or $3 trillion over a decade. A 25 percentage point increase could yield $800 billion or more annually. These aren't abstract numbers. That's real money that could reduce the deficit, fund infrastructure, lower middle-class taxes, or pay for health care. Instead, it stays in the wealth class, sheltered by the system. Closing loopholes and increasing IRS enforcement on the wealthy could raise $6.8 trillion over the next decade. That's $680 billion per year. The nation's entire fiscal gap, the difference between revenue and spending, could be closed by simply enforcing the tax code on the ultra-rich and eliminating the loopholes they use. But that's not happening. Why? Because the system was designed to allow those loopholes, and the people who benefit from them have the resources to keep them in place. Tax compliance costs, the money individuals and businesses spend on accountants, lawyers, and software just to file taxes, totaled at least $260 billion in 2024. That's 10% of the associated tax revenue. The system is so complicated that it costs $250 billion just to navigate it. And that complexity isn't accidental. It's a feature. The more complex the code, the more loopholes exist. The more loopholes, the more ways wealth can be sheltered. Simplicity would expose the design. Complexity hides it. Treasury and IRS officials have identified specific loopholes that cost billions annually. One loophole involving related party basis shifting transactions costs the federal government billions each year. Treasury has proposed closing it. Congress hasn't acted. Why? Because wealthy taxpayers and businesses pay accountants and lawyers millions of dollars annually to develop these schemes, and they pay lobbyists millions more to protect them. The cost of lobbying is a rounding error compared to the tax savings, so the loopholes stay. Politicians know about these loopholes. Both parties talk about closing them during campaigns, but once in office, almost nothing happens. The financial stakes are enormous, the lobbying pressure is overwhelming, and the complexity of the tax code makes it easy to hide inaction behind procedural excuses. Meanwhile, the wealth concentration accelerates. But who really pays the price when this system continues unchecked for another decade, another generation? Workers do. The middle class does. Anyone who depends on a paycheck instead of a portfolio. Because every dollar not collected from the wealthy is a dollar that has to come from somewhere else. Either higher taxes on workers, or cuts to services workers depend on, or more national debt that future workers will have to repay. There is no fourth option. The math is absolute, and the system is self-reinforcing. Wealth generates more wealth, especially when taxed lightly. A billionaire paying 24% keeps 76% of their income. That 76% gets reinvested, generating more wealth, which is taxed at 24% again, leaving 76% to reinvest again. Compounding works exponentially when the tax rate is low. Meanwhile, a worker paying 30% keeps 70%, and most of that goes to living expenses, not investments. They don't have wealth to compound. The gap widens automatically. The system accelerates inequality by design, and inheritance accelerates it further. The estate tax, which is supposed to tax large inheritances, has been gutted. In 2025, estates under $13.61 million per individual are entirely exempt. That's $27.22 million for a married couple. Only the ultra-wealthy pay any estate tax at all, and even they use trusts, loopholes, and basis step-up rules to minimize it. Tens of trillions of dollars will pass to heirs over the next few decades, largely tax-free, locking in generational wealth concentration. Other countries have designed tax systems differently. Finland's top personal income tax rate is 57.3%. Denmark's is 55.9%. Japan's is 55.95%. They use that revenue to fund universal healthcare, education, and social services. America's top rate is 37%, and even that rate is rarely paid due to deductions, loopholes, and capital gains treatment. The ultra-wealthy in America pay far less than their counterparts in Europe, and American workers pay comparatively more. America's tax system is actually one of the most progressive in the OECD when you look at who pays the most. The top 1% pays 33% of all federal taxes, but that statistic is misleading. It includes high-earning workers, not just billionaires, and it ignores effective rates. A surgeon earning $500,000 in wages pays 45%. A billionaire earning $500,000 in capital gains pays 20%. Both are in the top 1%, but their tax burdens are vastly different. The system protects wealth, not income. So if you know the pattern is real, and you know the system is designed this way, what do you actually do with that knowledge? First, you stop believing the system is broken. It's not broken. It's working exactly as designed. The people who designed it, the economists and legal theorists of the early 1900s, the legislators who wrote the tax code in the decades since, they built this system to protect capital. They said so explicitly. Progressive taxation was framed as protecting industrial capitalism in a more humane form, not dismantling wealth concentration. The system has always been about managing inequality, not eliminating it. Second, you recognize that the burden has been deliberately shifted onto labor. Every major tax reform since the 1980s has reduced taxes on capital and increased the relative burden on wages. The 2017 tax law was just the most recent example. The pattern is consistent and intentional. Third, you understand that the loopholes aren't accidental. They're lobbied for, legislated, and defended by people with enormous resources. Carried interest, stepped-up basis, unrealized capital gains, pass-through deductions, corporate tax breaks. These aren't oversights. They're features, and they're protected by millions of dollars in lobbying and campaign contributions. Fourth, you see the future clearly. If the system doesn't change, the wealth gap will continue to widen. The tax burden on workers will increase. Services will be cut or underfunded. National debt will grow. And the cycle will continue until something forces a change. That change could be political, a mass movement demanding reform. It could be economic, a crisis that makes the current system unsustainable, or it could be structural, a shift to a new economic model entirely. But the current trajectory is not sustainable indefinitely. The math doesn't work. Fifth, you ask what levers actually exist. Closing loopholes would raise hundreds of billions annually. Taxing unrealized gains above a certain threshold, say $10 million, would generate massive revenue from the ultra-wealthy without touching middle-class savers. Equalizing capital gains and wage tax rates would eliminate the structural advantage of wealth over work. Increasing corporate tax rates back to even 28%, still lower than the pre-2017 rate of 35%, would restore hundreds of billions in revenue. Funding the IRS to enforce the existing code would recover tens of billions in evaded taxes. None of these require inventing new systems. They require political will. But political will is the rarest resource in this equation, because the people who benefit from the current system have the money to influence the political process. And the people who are harmed by it, workers, don't have comparable resources. This is the paradox. The system was designed to favor capital, and capital now has enough power to prevent the system from being redesigned. It's self-perpetuating. So here's the reframe. The tax system isn't broken. It's functioning exactly as the architects intended. It shifts the burden from wealth to work, from capital to labor, from those who own to those who earn. It allows billionaires to pay lower effective tax rates than their secretaries. It lets corporations pay 0 while workers pay 30%. And it does all of this legally, transparently, and with the full support of the legal and political structures that maintain it. The uncomfortable truth is this: the system punishes work and rewards wealth, because it was designed by and for people who had wealth, not people who work. And until that design is dismantled and replaced, the pattern will continue. The gap will widen, the burden will shift further, and workers will keep paying more while billionaires pay less. You can't opt out. You can't avoid it. You're inside the system whether you understand it or not, but understanding it gives you clarity. It tells you why your paycheck is taxed at 30% while Jeff Bezos pays 0. It tells you why corporations get $188 billion in tax breaks while you can't deduct your commute. It tells you why the wealth gap is exploding while your wages stagnate. It's not random, it's not broken, it's designed. And the only way it changes is if enough people see the design, understand the pattern, and demand something different. Not because the system will fix itself. It won't. But because systems designed by people can be redesigned by people, if enough of them decide the current design no longer serves them. If this gave you a new lens on what's actually happening, subscribe. Because the answers are rarely in the headlines. They're buried in the tax code, the legislative history, the lobbying records, and the century-old architecture that most people never see. The system isn't broken. It's working. And that's the most terrifying part.